In this video, you'll be learning about this topic.
Tony Robbins wrote this book, Money Master the Game, and the best part of that book, at least if you ask me, was his interview with Ray Dalio. And Robbins asked Dalio there in the book, if you could leave a portfolio for your kids that could not be changed, what would the asset allocation be? And Dalio allegedly said something like 40% long-term bonds, 15% medium-term bonds, 30% in equities, and 7.5% in commodities and 7.5% in gold. Is that similar to what you guys are doing in your ETF? And are those percentages even correct?
It's similar. Frankly, I saw that. I was still at Bridgewater when that came out, and I'm not exactly sure where Tony got his allocation from. I think there was some interpretation that went into that. It wasn't literally from Ray's lips, but I'm not 100% sure about that. But there's obviously similarities to what we're doing. And again, the idea is this was the genesis of all weather for Ray, which was to create a strategy that would last for generations in his family and would not require active management. So it was the ultimate investment strategy. And that framework, even though we implement it differently, that framework is really the governing framework on how we think about asset allocation as well. And then that informs how we do our risk parity portfolio.
So I'm glad you brought up the all-weather portfolio. So for those who don't know, all-weather is a fund at Bridgewater Associates that is supposed to survive through the 4 economic seasons we talked about. And from what I've gathered, it's averaged a rate of return around 8% with maybe a similar level of volatility. Is that sort of the expectation with this portfolio as well for the retail investor?
We've built this portfolio to target about a 10% annual volatility. That's in line roughly with a 60-40 portfolio. And we think we can generate a return competitive with equity, so in excess of a 60-40 portfolio. So that's how we've designed this. And Bridgewater has a number of ways that they implement this portfolio. So it depends on how they package it, but that's how we've structured it.
So this risk parity ETF, RPAR, has an expense ratio of 50 basis points, so half of 1%, which is essentially the fee that you're charging the investors for managing the ETF. But that said, RPAR is holding lots of other ETFs that I know also charge similar fees. So is the 50 basis points inclusive of all of those fees or in addition?
It includes all of those fees. So that is the total net expense ratio.
Yeah, and to keep the fees low, we use ETFs where there are low-cost options, like Vanguard ETFs, for example. In cases where there are no low-cost options, we actually get the index exposure by just buying the securities directly to avoid that additional layer.
So if RPAR is holding all of those, say, low-cost ETFs from Vanguard, which advantages would it give me as a retail investor to hold the APAR ETF compared to buy up the underlying ETFs that APAR is holding in the first place, and thereby saving the cost for your ETF?
It's a great question. And it's something that we've been dealing with for about 15 years because we used to do that. We used to buy the underlying assets. And in one word, the reason it's better in the ETF is efficiency. So the ETF is very tax efficient. So for taxable investors who take all those assets and put it inside of the ETF, you gain tremendous tax advantages where effectively most of your return is deferred until you sell the ETF as opposed to generating taxes throughout the process. The ETF has about 20% of leverage within it, as we described earlier. That's achieved at a very, very low cost, near zero. So that's fairly attractive. I'd say the biggest advantage of the ETF is implementing the strategy is, while it's easy to talk about, it's hard to do in practice because it's so different from the traditional approach. And anybody who's been managing even their own portfolio or other portfolios realizes that humans are hardwired to look at their portfolio, their eyes go directly to the thing that's doing the worst, and their emotional response is, how do I fix this? This is the problem. And what you're supposed to do is buy the things that are doing the worst rather than sell the things that are doing the worst. And because all the assets in here are relatively volatile, they move around a lot. And so your emotions are going to be pulled in all different directions if you're trying to manage this outside of the ETF structure. And so what you're supposed to do is buy low, sell high, but the emotional reaction typically is buy high, sell low. And so this prevents you from doing that because the package is much more palatable and easier to hold on to than the underlying line items. And so that's actually one of the biggest advantages of putting everything inside the ETF. And we just talked about the fees. So the fees are very reasonable. And in some cases, a lot of the assets inside have no additional layer of fees. And then the last advantage is there is a little bit of discretion in extreme cases. So for example, in March, when the deflation alarm started to sound, balance in a deflationary world is a little bit different from all other environments. And so the portfolio targets changed a little bit. The allocation to tips went down, the allocation to treasuries and gold went up. And that trigger occurs because of our understanding of what it means to be balanced in these extreme environments. And so that also occurs within the ETF. And if you're doing it outside, you may not have that insight.
One thing that Alex mentioned, I think, is an important point that a lot of investors maybe don't fully appreciate, which is the benefit of rebalancing regularly and what that means from a return perspective at the portfolio level. So we've looked at this mix of assets because we created this index going back to 1998. So we've looked at this since 1998 explicitly in the index context. We've also looked at it with similar exposures back 100 years. And what we found is by rebalancing regularly, the portfolio return is about 1% higher on average than the average of the underlying component return. So if you took the average of the stock component, the treasury component, the tips component, et cetera, that average is 1% lower than the portfolio average return, which is really powerful from an investment perspective. And something that we don't think a lot of investors appreciate to the degree they should, partially because when you rebalance across similar things, you don't have nearly the same benefit. That benefit exists. It's proportional to how lowly correlated the components are. This gets back to your original point of the Holy Grail. The Holy Grail isn't just a risk-reducing phenomenon. It's also, if you can find things that are lowly correlated to one another and individually are quite risky and combine them in a portfolio, you actually get a portfolio that's higher returning than the underlying components. So that is a really powerful aspect that we've been able to take advantage of in the context of the ETF.
Yeah, it's kind of the oldest rule in investing: buy low, sell high. And it's just hard to do. And the reason it's easier to do with these assets is because you're not betting on any skill or anything like that. You're just betting that you have mean reversion in broad asset classes that have been around a long time. It's easier to have confidence in that.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.